Here's Brian with today's Real Estate Show.
Good morning, Charleston, and welcome to this week's edition of the Brian Beatty Real Estate Show here on the Big Talker, 1250 WTMA and WTMA.com. We've got a lot of ground to cover today. This week on the Brian Beatty Real Estate Show, I want to talk about a few things. Number one, Wall Street has just downgraded 6 of America's largest home builders all at once. It's not a rumor. It's a research call from one of Wall Street's most respected shops. And when you line up the analyst notes with what builders are actually reporting, there's a pattern that's emerging. Margins are cracking, incentives are rising, and I think just the overall demand response that we were expecting from slightly lower rates really just hasn't shown up. So I'm going to unpack 5 indicators that I'm keeping an eye on right now that I think you need to understand. And of course, we'll bring it home with information on the Charleston real estate market, right? Prices, days on market, inventory, affordability, and I think where leverage is starting to shift. So look, it's not 2008 all over again. Let's get that out of the way first. But affordability pressure today is in many ways worse than when we had the crash in 2008. I'll explain why and what to do about it. So, for those of you that are just tuning into this program for the first time, I've been on this program for about 14 years almost, giving you my opinion of the real estate market. As somebody that's been selling real estate locally for the past 20 years, we've done about 1,500 transactions, about $1 billion worth of real estate represented in that time frame. And so I share my experiences with you, what I'm seeing, what I'm reacting to, how I'm leading my team and ultimately our clients to successful transactions. So that's what this show is really all about. It's to educate and inform and hopefully entertain a little bit along the way as it relates to what's happening in our real estate market and some things you need to be aware of so that you are in fact a informed consumer. So that's what this show is all about. So let's kind of start with one of the things that in my mind kind of set off my radar. So on October 7th, Evercore ISI, which is a company that provides all kind of analytics and so on and so forth with regard to stocks to Wall Street, downgraded 6 major builders, right? D.R. Horton, Pulte Group, KB Home, Toll Brothers, Meritage, and Tri Pointe. They changed it from outperform to in line, which essentially means they no longer see these names as market beaters, right? Well, even after mortgage rates eased roughly half a point earlier, just a little while ago, actually, it just didn't seem like the buyers came flooding back like so many models predicted, right? There were all these agents that are like, well, as soon as we have just a little bit of relief from interest rates, the floodgates are going to open and everything will be back to normal and prices will start going up yet. We have not seen enough of a change in interest rates to spark more demand. Now, and I'll get into that more here in just a little while, but the response from the buyers based on that decrease in interest rates really just, it didn't happen. It didn't come flooding back like they thought it would. So it's not a supply story, it's a demand problem, right? So after they were downgraded, you then look at the earnings. And this is where things get pretty interesting. Lennar, as an example, their last quarter gross profit margin was down to 17.5%. This time last year, it was at 22.5%. That's a 500 basis point compression, right? It's fast, it's painful, and the management, even when they were going through their quarterly earnings report, acknowledged pricing pressures and incentives, right? They're having to do more to get deals done. This is exactly what you see when builders have to push to move specific inventory, right? Rate buy downs, closing cost credits, upgrades, all of that, of course, just chips away at their margins. So, before anyone goes and says, look, this is 2008 all over again, let's frame this just a little bit, right? In 2006 to 2008, the weak point in just the grand market overall was bad credit. You had subprime and no documentation loans that were just blowing up balance sheets on lenders. They had a lot of bad debt that they had lent out. The underwriting quality today is significantly different, right? You can't just go to a bank and tell them how much you make. They're going to say, prove it, right? Which is a good thing, right? There's no reason why somebody should be able to, I should say, just go to a bank and say, hey, if I just tell you how much I make, is that okay for you to give me a mortgage? Right? It was a bad idea from the start. But, we had 1 in 3 loans that were what we call subprime. So today, of course, underwriting is significantly different. The quality is much higher. The stress point now is affordability and really demand elasticity. How much extra incentive it takes to get a buyer off the fence at today's prices and rates, right? So, Wall Street sees that and they're adjusting their calls accordingly. So when you have multiple top tier analysts basically saying the same thing on the same day, it's enough to get my attention, right? That's real noise. And, the issue with builders, which we see across the country, is that there were several years there from 2020 to 2023-ish where the market was going gangbusters and we couldn't keep up with inventory demands. We saw massive decreases in what was available for sale. So builders who were already way behind pace decided to jump in and absorb more inventory and start building more homes, right? Well, now you look at areas like Florida and Texas that are in real trouble. We'll talk about that a little bit later on, but they're having to do things like, 0% mortgages for, an introductory period, or massive buy downs or massive incentive upgrades that they're just going to take off of the quote unquote purchase price. So they're having to do a lot more to get buyers in the door. When it becomes really challenging is when you own a home in an area where you're going to be competing with all of these home builders. This is what's changing the market. And a lot of it has to do, especially in the entry level and to an extent the move up markets, is people are having to compete with builders. Those builders own the mortgage companies. The mortgage companies are taking a total bath on any sort of profit just to be able to sell the real estate. This is why you're seeing margins get compressed. This is why, the stock was downgraded. And it's also why Warren Buffett just took an interesting position in D.R. Horton, I believe. We'll get to that in a minute too. But really what this is all pointing toward is affordability. At the end of the day, that's what drives the decision for the majority of people. I would say the people that would like to move, right? We've got a bunch of people that need to move. There are things that happen in our lives that cause us to then sell a home, or to just look at it through, realistic lenses and say, it makes more sense for me to buy than rent, right? So you have people that are going to buy or sell no matter what, because life either throws them a great opportunity or a curveball. Then you have all the people that are sitting on the fence that are saying, I would like to move, but there's nothing pushing me out of the house. I don't have to take a haircut on the sales price of my house just to be able to sell it. Either that, or I just don't want to go and essentially double my payment. If you're looking at a $400,000 house and you compare it with somebody that has a 3% mortgage to somebody that's going to go and get a 6.5% mortgage, that's an extra $10,000 a year just in housing costs. So when we come back, I want to talk a little bit about some just affordability math. We did that last show to an extent, but I think it helps to really open people's eyes when we talk about some of these numbers. And then I want to talk about something we've talked about on the show before, which is called the lock-in effect, right? It's halting a lot of people from making the decision to, frankly, compete in this market right now in order to sell or buy. So I want to talk about that, and I want to talk about why demand really isn't responding the way it should be, both nationally and right here in Charleston. So stick around. We've got a lot more to talk about right here on the Brian Beatty Real Estate Show. But if you'd like to reach out to me, you want my expert opinion on the value of your home, or You just want to talk about your situation, figure out the best path forward, even if that means waiting for the right opportunity to present itself. We've got a lot more options than what you would just think of as a traditional real estate practitioner that really is more of a transaction processor, right? We can do so much more than that. So if you'd like more information on working with my team and some of the interesting things we can bring to the table, my number is 843-800-0065. That's 843-800-0065. Or go on listingsincharleston.com. That's our website. And remember to check us out on YouTube. We take all these radio shows and, I video myself while I'm in here. We put that on YouTube so you guys can put a face with the voice. So check us out on YouTube and then our socials, listingsincharleston.com. So we just talked about really where the market stands right now and some of the issues that I have on my radar as somebody that follows the market incredibly closely so that I can then, of course, relay that great information to you guys that listen to the show. Many of you do on a consistent basis, but if this is your first time listening, I do want to remind you that we've taken all of our clips, over 1,000 clips, and put them on YouTube. So if you just search the Brian Beatty team, you can find us there. Or if you want to give me a call, 843-800-0065 is my direct number. You can call or text 843-800-0065. And listingsincharleston.com is the website, listingsincharleston.com. So let's do the math that's basically breaking this market. And if you go back to the show I did previously, I went pretty deep into how the impact of prices and rates in relation to incomes has created this big spread, this big hurdle that we as a market are struggling to overcome. It's more like a brick wall. So let's just do a little bit of math here. Nationally, the National Association of Home Builders estimates that about 74.9, let's just call it 75%, of U.S. households can't afford a median-priced new home, which is priced at about $460,000 with rates in the mid-sixes. That's a little over 100 million households that are priced out of the market. It's 3 out of 4 people, right? And if you go back to the show that I did previously, I've got a lot more specifics on our local market, but that's what's happening nationally, because what's happening nationally right now does in fact impact our local market, right? There's the trickle-down effect. Meanwhile, you also have first-time home buyers that now only represent 24% of all transactions. That is the lowest in the 43-year history of the National Association of Realtors profile on, it's the National Profile of Home Buyers and Sellers, right? It's the lowest it's been in 43 years since they started creating that data. The median first-time buyer is now also 38 years old. And that's not a small shift either. That's a lost decade of earlier home ownership and the equity that is created as a result of that. What's really important to understand is that we have the first-time home buyer market as an incredibly important piece to the puzzle, because first-time home buyers purchase first-time home sellers that then go and buy something more expensive, right? That's the chain of events that more often than not leads to people being able to move up into a higher-priced, more valuable, bigger, better home. But if the buyers aren't there to purchase those properties, then that wrinkle in the market sends shockwaves through the rest of it, all the way up to the luxury market. Obviously, luxury being a little bit of a different animal, but you can see how it still applies, right? So we have a big problem in that first-time home buyers, given everything, right? Given the fact that they're crippled with student debt, with the fact that just they have debt in general, that needs to get taken into consideration when someone does something called a debt-to-income ratio calculation to say, all right, well, how much money do you make? How much of it can go toward housing? How much other debt do you have that requires you to pay something on it monthly? There's only so much of your income that you can use, given all these other debts, toward housing. And that's why it's really challenging for people to afford a higher-priced home. They just don't have the income. Either that or they're just in bad shape financially, or they've financed cars and they've got student debt or whatever it is. It makes it really challenging in that market. But on top of that, we also have to think about how much more money they have to save in the form of a down payment because prices are higher. And if they're not doing well financially, the rate at which they can save for a down payment is why first-time home buyers are now 38 years old. So now let's talk about what is referred to as the lock-in effect. Roughly 2/3 of existing homeowners refinanced in 2020, 2021, and now hold mortgage rates with a 3 or a 4 in front of it, right? Today, a 30-year fixed rate is still it's somewhere in the mid-6s, right? Now, if you sell a home as a $400,000 house with a 3% mortgage rate, and you buy that same priced home with like a 6.4% interest rate, your payment jumps up hundreds of dollars a month to the point where you're now, and it's an extra 10 grand a year just to afford that same home. It's actually closer to 1,000 when you incorporate taxes and insurance, which both are going up. Well, a lot of families are doing the math, and they just said, well, we'll just wait. We'll wait for prices to come down, or we'll wait for interest rates to come down because we just can't get into the market right now. So that's why existing home sales slid to really generational lows earlier this year, while builders kind of became the pressure valve of sorts. And then they hit affordability limits too. I mean, new home sales did spike in August to, I think, an 800,000 unit annual pace, but the month's supply is still at 7.4, and anything over 6 months is considered an oversupplied market. So you have all these folks that are basically on the sidelines right now, and they're wondering what it's going to take for them to be able to sell their home and buy another, right? If we're talking about the folks that, yeah, I'd like to sell my house. Nothing's forcing me to sell my house. I'm not in a rush to sell my house, but if the right opportunity presented itself, yes, I'm ready to sell. Here's the challenge. We have an unprecedented amount of equity as a nation in our homes, right? We've got a ton of it. Trillions. A lot of folks don't want to give up the equity that has been created over the course of the past several years, depending upon how long you've owned your home. All of us, if we had owned a home starting before COVID until now, have seen almost a 50% increase in the value of their house. That's massive, right? People don't want to let go of that money or what it was worth at the very peak of the market, because we're not at the peak anymore. I think we've kind of bounced off the top and come down a little bit. The real question people need to ask themselves right now, if they're thinking of selling a home and buying another, is, are you willing to compete in this market right now at today's values and position your home to sell or not? Because the people that are putting their homes on the market saying, well, if it sells, it sells, and everybody knows it's overpriced and it's not going to sell for that amount, really what you're doing is you're helping other better priced homes sell first. And the longer you, and this sounds a little harsh, but frankly, it's true. The longer you stay on the market at a price that we know it won't sell for, the more it creates an opportunity for people to undercut you on pricing. And make no mistake, that game has already started. Sellers are already chopping each other down at the knees to try and be the person that sells first. And this is what happens naturally in a market when you start to see some saturation. You start to see things taking longer to sell. The ones that are priced well sell right now. They sell quickly. I mean, we still have 1 in 3 transactions that sell over asking price. It's not that it's a bad market. You just have to be realistic about what the market is. If your home isn't going to sell at the price that you would like, and you haven't looked at what the price needs to be in order for it to sell, if there's too much of a disconnect there, then just decide not to sell your house. But what's going to happen, in my opinion, is it's a death by 1,000 cuts. Right now, in this market, that's essentially what's going to happen. People are just very slightly undercutting. We're seeing it's a 36% of all listings are reducing their price in order to sell. And that's kind of the reality of the market is you don't have to be one of those people that has to reduce your price in order to sell. You have to price it correctly to begin with. If you price it correctly to begin with, you get all the people that are on the sideline right now waiting for new inventory to hit the market, right? Because you have all these folks that are essentially dealing with what I guess I could call the leftovers, right? The homes from this spring, summer, and early fall that just haven't sold, and they're still on the market. A lot of them are making adjustments in order to sell, or they're just taking it off the market entirely, saying, I'm not going to compete in this market right now. The question is, will it be better in the future or worse? Again, what's happening is people that are savvy are pricing their home to sell today rather than having to reduce it even more to sell tomorrow. That's essentially where we are as a market. And so that's the question that you, as somebody that's going to sell their home and buy another, really needs to ask yourself is, are you prepared and willing to sell your home at what today's market says your home is worth, not what it was worth at some point in time that you'd like to still hold on to? If the answer is yes, the nice thing is that because of some of the changes we've seen in the market, it's a lot easier for us to do something like negotiate a home sale contingency, right? Sellers are a little more open-eyed and willing to negotiate with buyers that might say something like, hey, I really want to buy your house, but I have to sell my house first. Would you be willing to give me, 4 weeks, 6 weeks, 8 weeks, 12 weeks, depends on the seller's situation, in order for me to get my home under contract so I can buy yours? Well, several years ago, the answer was absolutely not. It was really, really hard for somebody to get a home sale contingency approved on an offer. Whereas now, I think the vast majority of sellers would say, you know what, if that gives me the option or the ability or the opportunity to sell my home at that price, and all I'm relying on is them to sell their home as well, then yeah, I can deal with that. There are other ways of doing that, and I've talked about that ad nauseum on the show, so I won't go through that as well. But that's essentially where we are. So what's actually different from 2008? Credit quality is better. Equity cushions are bigger. But the monthly payment hurdle is the tightest part of the vice. Homeowners, I think, are handcuffed to great rates, and rightfully so. If they don't have to move, they're not going to. If they'd like to move, then again, they have to ask themselves the question of, are they willing to compete at the price that's necessary for you to sell your home in this market or not? And if the answer is no, then what are your options? I guess you could decide to sell later and hope that the market improves, or just stay put for a prolonged period of time and wait for the market to naturally take a turn. The problem is, because the market's flat right now, we're not entirely sure which direction it's going to go. I personally think that we're in for a bit more of a depression than, not depression in economic sense, but I think the market is going to deflate. How about that? That's a better way of saying it. Because I think that while people are waiting to get into the market or waiting to adjust their price to something that's more, appropriate or attractive, more and more listings are hitting the market. More and more people are deciding to sell, and it's creating a supply issue on top of a demand issue, right? Because the demand issue is fueled by the affordability issue, right? So where is the stress showing up first, right? Where are the markets that are starting to crack? Where are the opportunities, or where are the places and price ranges where it's still a safe bet to put your home on the market and realistically assume that it's going to sell in the next 30 days or less? If you'd like to, pick apart the market, if you want to do some planning, if you want to do some timing, I talked last show about how I go about the process of timing a market based on somebody's situation. If you want that kind of expert level of consultation, happy to discuss your situation with you and see if we might be the right fit to help. My number is 843-800-0065, 843-800-0065. Check us out online at listingsincharleston.com. That's listingsincharleston.com. I always like to take a moment and just say thank you, to let you guys know that I appreciate you listening to this show. I really do. I appreciate all the folks that call and, anything from a general knowledge question, which I'm always happy to answer. I'm appreciative of the fact that I can be a resource for you for whatever it might be. Maybe it's a good contractor recommendation or an electrician or a plumber. Or, of course, maybe you're interested in buying a home, selling a home, investing in real estate, or you have a property you'd like for us to manage through our property management company. Either way, just love to be a part of this program and to share my opinions of the market and help educate and inform you guys so that you are, in fact, informed consumers. I do think that folks that listen to this show and then ultimately become clients have a leg up on the competition, right? And usually we win and we win big. So thank you to those of you that reach out to us. If you would like to reach out, feel free to give me a call. My personal number, 843-800-0065. That's 843-800-0065 or listingsincharleston.com. So we were talking about really just some of the warning signs that I'm looking at in this market right now, right? We also have, and I forgot to mention this, but, you look at like what investors are doing. There's Warren Buffett's a great person to look at for stuff like this. Berkshire's latest, 13F disclosures showed that he took new positions in D.R. Horton and Lennar and put a larger amount into Lennar than he already had, which is always interesting, right? Because we saw their stock prices come down. We know that their profit margins are getting compressed. We know that they're having to come pretty close to selling their soul in order to make a deal happen in new construction is basically the takeaway on that. And so what does that mean for timing? I think Buffett generally thinks in 5 to 10 year horizons, right? It's a structural bet on housing that he's making and on the builders with the balance sheets that can survive a fairly lean period. It's not necessarily a promise that the next 4 quarters will be smooth. I don't think that Buffett does a ton of short-term speculation, but he's betting that in the next 5 to 10 years, this situation will have corrected itself and builders will be in a better place. But I do think that there are some rocky moments ahead for our market for the reasons I've mentioned earlier in the show. And if for whatever reason you missed that, you can always just check out the shows on YouTube because we upload them a few days after the weekend that it airs. There's also a lot going on in like Florida, as an example, and Texas too. I mean, properties are sitting on the market way longer than the national median. A lot of sellers are just pulling their listings off the market rather than cutting price. You're seeing a lot more short sales in that market. We haven't talked about that in ages because we haven't needed to, but a short sale is when you sell the house for less than what you owe the mortgage company. I mean, it's not worth enough to pay off the mortgage after closing costs. That's not as much of a concern here because of the incredible amount of equity that has been gained. The appreciation of real estate here has been pretty wild as everybody kind of flocked to Charleston during the pandemic. But we're seeing, like all kinds of things, rate buy downs, 0 down payments, rent to own on new construction. All of it is just, signs of slower absorption. Texas is seeing the same thing. They have more new construction inventory than there is demand right now. And what's interesting is in 2008, it really started more on the West Coast, California, Arizona, Nevada. I mean, Phoenix, Las Vegas, those markets were a mess. They were riddled with foreclosures because it was a highly speculative market before that. And you had your local bartender with 10 rentals because he didn't have to prove he was a bartender. He could just tell people how much he made. That's obviously not the case now. We're in a different situation. But again, the issue, right? The bubble, the concern, the crisis, whatever you want to label it as, is on affordability, right? It is the combination of high prices and high interest rates in relation to income. And it's causing a lot of people to just say, it's just not, it doesn't make sense for me to move. And that's a big structural change because, you think about it a few years ago when interest rates were around, 5 and then they dropped to 3 and below 3. And you looked at yourself and you're like, well, wait a minute, I've got equity in my house. I could sell it, not have a down payment, and actually have lower payments on a bigger, better house. Why not? Or you could look at it from this standpoint and say, you know what, it's going to cost me more to rent than it's going to cost me to buy. I've got some savings. Payments are, affordable. I might as well buy a house. Well, not anymore because, again, only 24% of the market is first-time home buyers. The target's more like 40%. So you've got all these folks that are priced out of the market. Anyways, blah, blah, blah. What I want to talk about, though, is, we've got these signs, these signals, these concerns that I think we need to watch closely, because not much in real estate moves quickly, right? It's going to take a while for these trends to do like real quote unquote damage to somebody's equity, right? It's not like prices are falling off the shelf. What's happening is it is now very clear to see the homes that are overpriced versus the ones that are priced correctly. The ones that are overpriced are just not getting the action. They're not getting the activity, and they're certainly not getting the offers. And if they do get an offer, it's from a really opportunistic buyer. And sometimes that's the challenge with a seller is like, well, why aren't people making us offers? Well, it's because they don't think you're going to take the offer seriously based on how much you're asking for your house. And I know these are really tough conversations, and there's no one-size-fits-all scenario or situation that applies to everybody that might have their home at a price for a certain reason or a certain amount of time, right? So I get that. But it is pretty plain and obvious to see, especially from a buyer's perspective, homes that hit the market, and let's say they're getting MLS updates, or they're looking at Zillow or realtor.com or whatever, and they see a new listing hit the market, and they're like, ooh, that's a good one. It's in good condition. It's marketed well. It's priced well. Yeah, that one's got to sell. They already have urgency because they understand value. I mean, if they're not in a huge rush, believe me, they've done their due diligence, and they have a pretty good understanding of what's going to sell quickly versus what's going to sit for a while. So positioning is incredibly important. But anyways, here's what's going on in our local market. Because I'd mentioned last show, we had in the third quarter of this year, it was really the worst quarter we've had since 2012 for the average number of showings we get per listing, right? Just not a lot of showings. I mean, the worst in 13 years. The median days on market was the worst September we've had since 2014. If you look at the difference between the listing price and the asking price, worst September we've had since 2014, right? Not a super September from a stats perspective, I'll be honest. But that's just the sign of a changing market. It's starting to really show up in the data. And if you can see it, then you can believe it. So that's kind of where we are right now. But as a whole in our market, if we look at the rate at which we're putting properties on the market, right? New listings, that's up about 7% year to date. If you look at properties that are going under contract, right? We call those pending sales. That's up a little over 1%. Closings are also a little over 1% up from last year. But it's taking about 27% longer to sell a house. It's taking about, in September it took 52 days. The year-to-date average last year was 38, so extra 2 weeks. Median sales price is up 2.3% year-to-date compared to this time, last year. The median sales price is $427,000. And we go off median because if I did average, the average is closer to 650. But we also now live in this world where you're seeing 10, 15, 20, $25 million properties, right? We've got a lot of expensive real estate here in Charleston, so sometimes that skews the numbers. And it's incredible that we've got, so many homes at that price point that are selling. People are paying it. But then I look at something like housing affordability. And again, this is what it all revolves around, right? We talk a lot about affordability indexes on this show, meaning if the median priced home is $427,000 right now, and the median income in South Carolina is $85,000 a year, that means that our local market, based on our local median income, is only 75% of what is necessary to afford a $427,000 house. Right? So that's the gap that's crushing the market, is the difference between what it costs to own something and how much money they make. Taking into account the fact that there's also other debt likely at play, right? Not everybody is debt free. Very, very few are. And so what's happening as a result of that is more properties hitting the market, staying on the market longer. We're not absorbing them at the rate that we're putting them on the market, which is creating a supply issue, which will, of course, in and of itself impact demand. The more options somebody has, the lower they're willing to pay. So we've seen an increase of 15% in inventory of homes for sale compared to this time last year. And we are trending toward what the numbers would suggest to be a quote unquote normal market where there's no real, it's a fair fight, right, between a buyer and a seller. Who wants it more? Or, if you've got a bunch of other homes that are for sale in your neighborhood, who's going to be the price leader, or who's going to do something to their house to help it stand apart from the rest, to earn that higher price. So interesting time in the market. We do have a little bit more to go, so I'm going to take another quick break and come back for the last few minutes of the Brian Beatty Real Estate Show. But if you're interested in getting a home equity analysis on your property, you want to understand what it would actually sell for in today's market, and then also understand all the costs associated with your sale, we can break all that down for you. And then the other thing I'll just say really quickly is, man, we're seeing a lot of off-market opportunities right now. A lot of folks that are signing agreements with real estate agents, but calling them a pocket listing for a while. We have access to a considerable amount of deals like that. So if you're thinking of buying a house, you might as well, check in with someone like me that also can show you opportunities that you can't find yourself because they're not publicly available. So if you'd like any of that information, feel free to reach out to me. My number is 843-800-0065. That's 843-800-0065, or listingsincharleston.com. So I've given you guys a lot to think about and chew on today with regard to some of the signs and signals that I'm keeping a close eye on that help me determine really what direction this market is headed in. So I figured for the last few minutes here, let's just do a little bit of a recap and really determine what to do with this information, right? If you're in a position right now where you would like to sell, but you don't have to sell, then I think you need to just have a very serious and blunt conversation with somebody that really understands the market, that can tell you if either one of two things, either this is what your home is worth right now, that we should, we can price it here, but this is ultimately probably what it's going to sell for. This is fair market value for your house. Now, if you have another price in mind, something higher, then here's what it might take in order for you to get that price. Does making some of those improvements to the property make sense, right? And we can go through an analysis on that. And, I don't talk too much about this on this show, but, in addition to running a real estate team and a property management company, I invest in real estate. I flip homes. So, every month or so, I'm writing a very large check for considerable repairs. I know how much things cost. And so we can very, very easily analyze, if you are to do some things to your home, here's how much it will cost, and here's what the resulting value will be. Does it make sense, yes or no, right? There's no point in spending money if it's not going to make you money or cause the home to sell before the competition. And I think sellers right now, one important piece of advice that I can give you is to price your home to win the showing appointment, not necessarily to test the ceiling, right? If you're in the top 10 to 20% of inventory for condition and location, you can still get constructive outcomes, but I think you need to be ready to offer or negotiate on the terms of the deal, right? Closing costs, rate buy downs, repair credits, so on and so forth. I mean, I'm structuring multiple seller plans that pre-price the buy down so that we protect their net. But I think at the end of the day, if you want to compete in this market right now, which is going to feel a little more sluggish than what we're used to over the past several years. And, let's be honest, what happened a few years ago with incredibly low interest rates created a massive rush and surge in the market that really benefited sellers. Now we're just back to, it's kind of a fair fight between a buyer and a seller. Buyers, and one more thing with sellers, marketing is so important right now. You have to align yourself with somebody that can differentiate your home from the others. Because if the plan is just to stick at the MLS and let it populate to all these websites, you're doing what everybody else does. You're not going to stick out from the crowd. And there's nothing that agent has done above and beyond to proactively identify buyers for your house and market to them directly, right? That's one thing that we do that really sets us apart from other agents. It's something we've done for years, and really, from a marketing perspective, that's what we hang our hat on as being the best thing we do. Buyers, I think you have more choice and more time than 18 months ago. I would get fully underwritten with a lender. I would have them run your credit. I would have them look at your tax returns and bank statements and recurring debts. Not for me personally to just say, oh, well, now I've got a pre-approved buyer, I can actually take this process seriously. That's not what I'm saying. I'm saying it for your benefit, so that if there are things on your credit report or debts that you have, a really good lender can act as a consultant and reshape things for you so that you get a lower interest rate. We're just trying to save you money. That's really what that's all about. So I would get fully underwritten, and then I would negotiate the structure of the deal, right? Repairs, credits, buy downs, rather than just the headline price, because you're going to get more bang for your buck if you negotiate credits or terms rather than just the price. And if you have a 3 to 4% interest rate today on a house that you own, look into renting out that property, keeping it as a rental. Does it cash flow? Does that help bridge the gap between what you're paying now and what you would be paying on theoretically a higher priced, more expensive, higher monthly payment home? And lastly, investors. I think you have to underwrite really conservatively right now on things like insurance and taxes and vacancy, right? The market is not gangbusters like it was. I'd target, flood resilient locations, strong school zones, and, product types that have a durable tenant demand, right? You always want demand from tenants that are looking at your rental properties. And I think cash on cash, just in general, is earned when you buy the property and then when you successfully manage it. So if that's something that you guys are interested in, whether it's buying, selling, investing, or helping us manage a property for you, we'd love the opportunity to assist. You can give us a call at 843-800-0065. That's 843-800-0065. Or check us out online, listingsincharleston.com, or, of course, on our YouTube channel, The Brian Beatty Team. Thanks a lot, guys. Enjoy your weekend, and thanks for listening to The Brian Beatty Real Estate Show on the Big Talker 1250 WTMA.
Join us for another edition of the Brian Beatty Real Estate Show next Saturday morning at 9 and Sunday morning at 10. Find him online at listingsincharleston.com. That's listingsincharleston.com. Or call him at 843-800-0065. That's 843-800-0065.